You see, if I get into trouble as a businessman with debt, I can declare bankruptcy and I'm clean.
Have you ever wondered how rich people use debt to their advantage? Imagine if you could use debt as a clever strategy to build your wealth. Even though many find the idea of debt frightening, not all debts are harmful. Wealthy individuals, for instance, use debt as a tool to generate more wealth. In this video, we'll break down simple ways for you to make debt work in your favor and help you reach your financial goals. People often feel scared when they hear the word debt. While debt is usually viewed negatively, it can also be a good thing if you do it right. One major way you can use debt for positive investments is through leverage, which means using borrowed money or other people's money to boost how much you gain from your investments. It's like a tool that helps you reach returns that might seem impossible initially, but it does come with a higher risk of losing your invested money. Understanding leverage is important for making it work in your favor while being mindful of the associated risks. This is why you need to understand the difference between good debt and bad debt. Good debt helps you gather assets that grow in value, and the loan interest is often tax deductible. You can use the income from these assets to repay the debt. Examples include rental property, shares, and investing in managed funds. On the other hand, bad debt involves buying things that don't generate income or lose value over time. The loan interest is not tax deductible, and there's no income from the asset to pay back the debt. Examples include credit card debt if not repaid within the interest-free period, personal loans for cars, and family home loans. Good debt helps you build lasting wealth, while bad debt can harm your credit and drain your finances. The key differences lie in risk and cost. Bad debt involves taking on too much risk without the ability to repay, making it either too risky or too costly. Consider these two factors before taking debt: the interest rate and how long it takes to pay back the loan. Also, think about what you're borrowing for. Your personal comfort with debt matters too. If you can consistently make your monthly payments, it also helps improve your credit score. The best way to use debt effectively is to have a solid plan in place. Tailoring your debt strategy based on your situation and risk tolerance can be a smart move. Imagine investing $100 with an expected 10% return. If you use all your own money, you'd earn $10. But by investing half your money and borrowing the rest, if the loan interest rate is then 10%, you could earn more. This is leveraging your return. Using good debt is a powerful way to tap into the potential of your money, creating passive income and building real wealth. Without debt, many wouldn't own a house or use their earnings to start building their financial empire. It's a strategic approach to make your money work harder for you. Wealthy people use debt because it helps them save money on taxes. By strategically borrowing, they can take advantage of tax benefits, allowing them to keep more of their earnings. Here are 8 ways you too can use debt to make you richer. Number 1. Investing in real estate. One of the ways you can leverage debt is by investing in real estate. When you buy real estate, you can use a small amount of money as a down payment, like $10,000, to own a much more valuable property, say a $200,000 house. You might pay $2,000 each month. If the property goes up in value, like 20% to $240,000, your $10,000 down payment could give you a big return of 300%, which is $40,000. Debt isn't just for buying. It's also used to get rental properties or Airbnb homes. This way, you can earn monthly income by renting them out. The cool thing is, the returns you make are based on the total borrowed money, not just what you put in. It's a way to make your money work harder and get some good returns. Number 2. Buyout. Another way you can take advantage of debt is through buyout. A leveraged buyout occurs when someone buying a company takes on a lot of debt to make the purchase. They use the assets of the bought company as a guarantee to get the company, planning to pay off the debt later using the money the company makes. Once the buyout is done, the buyer now has the main say in how the company is run. Number 3. Starting a business. Imagine you want to start a business, buy one, or make your existing business bigger. If you don't have all the money you need, you can use debt, which means borrowing money to finance it. This helps you get the funds required to begin or grow your business. It's a financial boost that allows you to take important steps, like opening a new shop or buying equipment, even if you don't have all the cash right away. Using debt wisely can be a smart move to make your business dreams a reality. Number 4. Margin investing. Investing on margin is like borrowing money to buy more stocks than you could with your own cash. For instance, if you had $50,000 in your regular brokerage account, you could open a margin account and put up to 50% of a stock's purchase price. So with $50,000 of your money and a $50,000 loan from your broker, you could get a total of $100,000 to buy stocks. If the stock price goes up, you can repay the loan, keeping the profit. But be careful. If your account value drops too much, your broker may issue a margin call. If you can't add more funds, they might sell your stocks, leading to losses. Number 5, diversification. Another smart debt strategy is using a loan to diversify your investment portfolio. This is particularly useful for wealthy individuals who have a lot of their money tied up in one company's stock. Instead of selling that stock, they can borrow against it and use the money to buy stocks in different companies. This creates a more balanced and diverse long-term investment plan. Plus, a bonus is that by borrowing against the concentrated stock, you might delay paying the capital gains tax that would come with selling it. It's a way to manage risk and potentially save on taxes. Number 6, leveraged ETFs. Leveraged ETFs are a tool that can boost gains for investors by betting on whether a specific index will go up or down. They allow you to multiply returns, sometimes by 200 to 300%, offering the potential for extraordinary profits during market booms. However, if not traded carefully, they can magnify losses and wipe out your entire investment in just a few days. They're a high-risk, high-reward option. Number 7, hedge funds. Hedge funds leverage debt to make bigger investments. They're known for making a lot of money this way. Some borrow up to 10 times the money they actually have. Billionaire hedge fund managers like John Paulson have used this strategy to make regular investors very rich. But if the fund manager makes a wrong investment choice, it can be bad news. It might even lead to the fund going out of business and all the investors losing their money. Examples like Long-Term Capital Management borrowed up to 30 times their actual money and needed rescuing. Number 8, to invest in yourself. You can also use debt to invest in yourself, like advancing your skills or education. It's a strategic move where you borrow money to make yourself better, whether by pursuing further education, acquiring new skills, or launching a project. The goal is to create opportunities for personal development and success by making wise investments in your own abilities and potential. Number 9, short selling. Short selling is another way debt can be used to make gains. Short selling is a way of betting against a stock. It involves borrowing shares from an investor and selling them, hoping the stock's price will go down. Some people have made a lot of money doing this when they correctly predict a stock's decline. However, the risky part is that losses can be unlimited, meaning short sellers can end up losing way more than they initially invested. Number 10, Forex trading. Forex trading lets investors control big amounts of money with just a little cash. You can leverage your accounts up to 100 times in currency trading. The good part is you can turn a small amount of money into a lot quickly. For example, George Soros made $1 billion by betting against the pound. However, you should know that currency trading also has risks. You could lose your entire account in just a few minutes, so carefully do your research. To set the stage for using good debt to build wealth, consider these 6 steps. 1. Debt consolidation. Combining multiple debts into one, like increasing your mortgage to pay off high-interest credit cards, can save you money on interest and fees. Your home loan's lower interest rate can help you pay off more costly debts. 2. Making your savings work harder. Rather than keeping all your money in a regular savings account, consider using an offset account linked to your mortgage. This can earn you a better after-tax return and reduce your home loan term without locking up your funds. 3. Better cash flow management. Efficiently managing your cash flow is crucial for minimizing bad debt. Strategies include paying more frequently on your mortgage, increasing payment amounts, putting your salary into an offset account, or using interest-free periods on credit cards for daily expenses. 4. Borrowing to create wealth. After minimizing bad debt, it's time to consider good debt, known as gearing. Wisely investing in assets like property or shares using borrowed funds can help create wealth. This strategy involves the income and growth from the investment paying off the debt and surpassing the costs of servicing it. You can generate extra funds by borrowing against your home's equity, taking a margin loan, or investing in a managed share fund. 6. Debt recycling. Debt recycling involves redrawing the equity you've paid off in your home loan to invest in shares or other properties. This turns bad debt, into good debt, generating income and offering tax benefits. Extra income can also speed up paying off your home loan, saving on interest. While following these steps, it's important to seek quality advice and understand both the risks and potential returns. Debt can enable individuals to make purchases that bring in high returns. It's all about using debt smartly. What do you think of using debt to create more wealth? Leave a comment below. And if you enjoyed this video, like and subscribe for more financial insights. And thanks for watching.